The open market is a hostile environment. Throw a fragile business idea into the wild without structure, and the elements will tear it apart. Survival requires a blueprint. Before a single brick is laid, an enterprise needs a detailed project report, a comprehensive map that tests technical feasibility and scopes out exactly who the target customers are. Once the plan is set, it has to be anchored into reality with fixed capital. These are the heavy, illiquid, long-term assets, the land, the factory buildings, the permanent machinery that give a business its physical weight and production capacity. But you can have a flawless blueprint and a fully equipped factory floor, and none of it matters if the state doesn't legally permit you to turn the engines on. For decades, securing that permission was a grueling process. Entrepreneurs would spend months caught in a web of dozens of fragmented government departments, stalled by paperwork for electricity, water, and environmental clearances. To clear that bottleneck, governments introduce systems like the National Single Window System. It acts as a centralized digital portal, instantly calculating the exact licenses a business needs and processing the approvals in one place. Clearing this system grants an entity its permanent registration, whether through UDIUM for small enterprises or DPIIT for startups. This provides a lifelong digital identity that legally recognizes the business. With a permanent identity established and the physical infrastructure built, the stage is set. The true risk starts the moment the business takes its first breath and the machinery actually starts moving. An active business generates value by coordinating 4 operational pillars: recruiting skilled man-hour, procuring raw materials, manufacturing the product, and marketing to the right buyers. To keep those pillars aligned, enterprises rely on continuous market research. By analyzing real-time data on competitor density and government purchasing trends, they create a tight feedback loop, ensuring what they produce matches what the market actually demands. Quality control then acts as the enterprise's immune system. Frameworks like the ZED, Zero Defect, Zero Effect certification exist to carefully identify and reject flaws on the factory floor, ensuring the product is pristine and environmentally safe before it ever ships. Moving materials and making sales quickly is important, but if an enterprise accelerates production while ignoring precision and quality assurance, it will rapidly manufacture its own collapse. The daily lifeblood of this operation is the working capital cycle. It tracks the timeline of how long it takes a business to convert liquid cash into goods and then back into available funds. The cycle starts with days inventory outstanding. This measures how long cash sits frozen on a shelf as unsold goods. The longer inventory sits gathering dust, the more capital is trapped away from the rest of the business. Next is days sales outstanding, which tracks how long it takes customers to pay after a sale. You might have shipped the product, but if you are waiting weeks or months to collect on those invoices, your cash remains locked in limbo. Finally, there is days payables outstanding. This measures how long a business can wait before paying its own suppliers. By smartly stretching out these payment terms, an enterprise retains cash to fund its daily operations. Keep this entire loop tight, and the business enjoys strong liquidity and the agility to grow. Let the cycle drag on, and the resulting cash gap will force the enterprise into a dangerous reliance on expensive external debt. Even with a perfectly optimized capital cycle, an enterprise remains vulnerable. Sudden material shortages, shifting policies, or a global recession can severely damage the healthiest balance sheet. This chart demonstrates how government intervention attempts to correct those market failures. By imposing a minimum price above the natural market equilibrium, the state deliberately creates an excess supply, using subsidies and legal incentives to protect producers from severe price crashes. Beyond price controls, the state provides specific insurance mechanisms. Systems like TREADS protect cash flow by allowing suppliers to essentially sell their unpaid invoices to banks, trading a small fee for immediate guaranteed capital. These institutional shields are highly effective at absorbing temporary external shocks. However, they cannot save an enterprise that is steadily bleeding out from its own internal mismanagement. This document outlines the distinct types of industrial sickness. The decline begins with incipient sickness, a critical warning stage where continuous cash losses start eating away at the company's accumulated net worth. Once the net worth is entirely wiped out, the company enters actual sickness.
This triggers the Insolvency and Bankruptcy Code. Brought before the National Company Law Tribunal, a legal moratorium goes into effect, halting all lawsuits and asset seizures to give professionals a strict 180 to 330-day window to find a solution. The final decision falls to the Committee of Creditors. They must choose whether to accept an investor's bid to salvage the business for its going concern value or admit defeat and sell off the dead machinery for its absolute base liquidation value. Building a lasting enterprise is a continuous act of resilience. It is the result of a flawless initial blueprint, optimized capital flow, and an absolute mastery of the economic fail-safes that survive the risks of the open market.